So welcome back. Let's talk briefly about financial markets, but perhaps first markets in general. Now I like to think of it this way, wherever there is a transaction between two individuals or companies or parties in general, there is a market, albeit a very tiny one when it's limited to maybe two participants. But on a larger scale with multiple participants, you can see that markets are taking shape. And you can recognize this, for example, in an easy example, in a shopping center or in a secondhand clothing market or a fruit market or things like that. And we like to say when we have a product, for example, say that you're an inventor, you invented an awesome electric car, and then somebody asks you, cool, nice product, but is there a market for that? Meaning, do you have an opportunity to sell this product somewhere? Is there people interested in your product? I like to think of it this way. A market is the place where buyers and sellers come together. Somebody with a desire to buy and somebody with a desire to sell in one place. So let's jump into the slides to discover financial markets. So a short definition of financial markets: a marketplace where the buying and selling of securities occurs. Okay, there you have your first term alert. Look up in the term-based what a security is. I'm not going to explain it in the video. I really want you to make use of this term base. But to get a little bit clearer picture of financial markets, let's just draw it out. And a financial market is not very different from a general market, except the product changes. So we have financial markets in the center, and then it consists of basically two parties. We have lenders, I hope this is readable, lenders and borrowers. To facilitate in the transactions between these two parties, we have something that we're all pretty familiar with. Banks, for example. Banks is just one example, there are more examples, but let's just keep it simple right now, clear and concise. So lenders are the ones who can provide capital or money in this case, and then borrowers are looking for money or capital. Now, a borrower could be, for example, a company, or it could also be the government. It can also be individuals. Whoever is looking to raise some money on financial markets is considered a borrower. A lender can be, for example, could be a company, but could also be an entrepreneur, whatever, a wealthy individual. Stuff like that. So somebody with money to spare that he wants to put to use instead of just leaving it on the bank. And this also includes, of course, investors. Someone on the side of the lenders who wants to, for example, invest in a company. Again, the important player here who facilitates in these transactions and profits from that are the banks. And so that's basically what it looks like in a nutshell. One more important thing, if we go to clear my screen a little bit, financial markets in the middle, and then we have basically two things to discuss. One is short-term activities, and one is long-term activities, meaning that if you want to raise capital for the short term, you're talking about activity in money markets. More on that in a separate video. And on a longer term, we are talking about capital markets. And this is where, for example, if you are a company and you want to expand and you're looking for a lot of funds, this is, of course, something that isn't done in a short term, like money markets, where we talk about, say, a period of several months or 12 months, but it could be a multi-year endeavor that you're talking about. In that case, we are talking about capital markets. So I highly encourage you to watch the video attached and also read upon the literature attached, because there is a lot more explained. There is a lot more to explain, but I don't want to take up too much of your time in this video. So definitely check that out, and I will see you in the next video in which we're going to talk about the history of financial markets. See you there.